Alright, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today, as promised, I've spent quite a bit of time going through the latest earnings call for Qudian. Not the first one, but the second amended earnings call when the share price tanked. And so I've spent the last week carefully going through the call, highlighting some of the key details that I believe are very important for us to consider. So I've put this into the video today, and like I said, this is just my perspective on the key points and some of the things that could be cause for concern or things for us to keep in mind. Largely, I was quite happy with the call. There were just a couple of things that I wasn't too sure about. So we're going to go through all of this today, and yeah, let me know your thoughts, and make sure to leave a like and drop a comment. Would be keen to hear and understand what you guys thought of the updated call. All right, so let's get into it. Okay, guys, so the first thing that I really wanted to point out in this call is, as you can see highlighted in the red oval over there, the sudden change in the way that management have started to talk about the APR. As you guys might recall from the latest call, they've all of a sudden started using IRR, not APR, which was a bit of a red flag for me. So that was the first thing I really wanted to bring your attention to, right? So as you can see on the call, the CFO said, look, in 2016 and 2017, we upgraded our businesses to 2 proper internet lending licenses, okay? And what we did was we put on a system-level restriction so that no credit products can generate over 36% IRR, okay? But this, according to my recollection, was the first time that they used IRR, and it was APR all along, right? And so they said, look, it's actually IRR, not APR, and effectively what they say is that a 36% IRR translates to a 20.6% APR on a standard 12-month loan, and that the effective APR for the third quarter, which was their most recent quarter gone, was 20.5% APR, which actually it was a massive shock to me, right? And the reason being is because all along they've used APR, and this was the first time they ever used IRR, and I'll tell you what I mean, okay? So guys, as you can see, what I've done is I've gone back through all of the calls that they've had available since they went public in 2017 and highlighted each and every time the word APR was used, and not once on those calls did they use IRR, which was really strange, right? So as you can see here, okay, so Q4 2017, APR, 36%, 36%, okay? Q1 2018, same thing, right? APR, 36%. APR, we intend to keep it APR. Q2 2018, same thing, APR. Okay, and then Q3, hold on. Not too sure why I've got Q3 2017. I think it should have been Q3 2018. Might be a typo, right? But again, APR, right? Q4 2018, APR, right? And as you can see, it continues all the way through to even the most recent call, which was the first call of Q3 2019. Okay, guys, and as you can see, it's APR all the way through. So this makes me wonder. I'm like, okay, so what the hell's going on, right? If you guys are saying APR all the way through, why the sudden change of tone? So subsequently, what I did was I actually reached out to the investment relations chap, Ben, to actually ask him the question, and I said, look, I said, hey Ben, hey Carl, because I CC'd the CFO on the email as well. I said, look, I just really wanted you guys to clarify, why was management using APR to measure revenue all the way up until the most recent call, and then it was on the subsequent clarification call that IRR was used, and that if IRR should have been the metric to be used all along, why wasn't it used from the beginning, and will management be going back to revisit all the times that they've said APR to correct it to IRR, and then give us the actual APR, not IRR, for those calls, right? So as you can see, this is a bit confusing, right? And so what I did was I sent that to the IR chap and the CFO. And of course, I heard back very quickly from the IR chap. And this was what I thought was even more strange, right? So he says, look, thanks for the continued support and keen observations. We have previously used APR and IRR rather quite interchangeably, but yes, in reality, we have always been working on a more conservative 36% IRR. Nonetheless, in our communications with investors and analysts before, we've always explained how we've calculated interest rates based on an IRR, average delinking repayment model, which, like I said, I could not find IRR occurring once going through all their subsequent earnings calls. So not too sure about that, right? So he goes, look, this quarter we felt it would be necessary to clarify the actual interest rate that we charge, to explain this to the broader investor community as some of the peers did. And we also announced that in the past 9 months, our annualized APR is actually 20.5%, roughly 36% on an IRR basis. So my take of this was that this is actually a complete change of tone. So I said, hey, Ben, look, that's cool, but I couldn't actually locate anywhere where you announced APR at 20.5 and IRR at 36, except for the most recent second call, which was the update call, right? So I said, hey, look, can you actually get back to me and tell me exactly where you said this in your older calls, but more specifically, if you can link it to me, right? And so now he wasn't very quick to respond, but obviously, look, I emailed him in the weekend, so he's probably enjoying his weekend. I don't blame him, okay? So what I'd be keen to do is to keep an eye out on whether he responds to me next week. So that's one of the key things that I actually wanted to highlight to you guys, okay? But apart from this point, I was, pretty happy with how the rest of the call went. So let's go through the rest of the call and some of my notes, okay? All right, guys. Now we're not going to run through each and every paragraph line by line on the call, but I just wanted to run through a few things that I highlighted, okay? The first thing is, as you can see highlighted in this paragraph over here, effectively what the CFO is saying is, hey, look, we've, our financial institutions, our funding partners, they like us, they stick with us, right? We've grown it from 1 to 4 to 11 in the space of about a year, and now it's going to be 17, and then we're aiming for 20 by the end of the year, and the repeat borrow rate is, over 70%. It's actually closer to 78 if you look at the latest, most updated investor presentation, okay? So I think the importance of this point was for somebody like Terracotta. Now, I don't actually think Terracotta is an individual investor. I think Terracotta works for a hedge fund, okay? So I think this is what the CFO is saying. Look, we would not be growing our partners if they thought we were dodgy, and retention rate would not be close to 80%. So yeah, that's number one, okay? Okay, guys, second thing that I wanted to highlight is, as you can see the paragraph over here, now, effectively, what this is saying is that you can almost call Qudian kind of like a service, but a trust pilot for lenders and banks, where they can all come onto this one open platform, and it's got all the data analytics. Then they can add their own analytics, and then everybody sort of data shares about the quality of the borrower, the asset, the customer, likelihood of default, and etc. So I think effectively what this guy is saying is, look, we're ramping up our platform slowly. The banks can collaborate and corroborate with each other to find the best borrowers, because obviously there's a bit of a turn down in the Chinese economy, okay? So as you can see, I've got a note here. It's almost like a marketplace for borrowers, for the banks to come and have visibility over everybody. Okay, so that's my take, and I thought this was quite interesting, because it is true, right? There's a large portion of people without credit ratings in China, and that these people want visibility to find the highest quality borrowers. So look, I think that's a fair comment. Okay, guys. Now the third thing that I wanted to focus on is this paragraph highlighted over here, and I think this is important, and the reason being is because, the CFO is giving us his take on how long he thinks it'll take the peers to catch up to them, because they're the first mover in the open platform, okay? And just remember, they've got 250 billion of existing transaction data, and he thinks it'll take 12 to 24 months for the peers to catch up if they can actually replicate the volume of the data. Now, for the sake of being impartial, I think right down the middle in 18 months, my understanding is that, look, they should have a good 18 months runway before their services start getting commoditized, whereby they can no longer get the 9-10% take rates and it'll have to go down to 5 and 8. But what this means is that, holding Qudian over the next, 18 months, I don't think it'll be a problem, right? So I actually think that they've got quite a bright sort of a year and a half ahead of them, provided the Chinese economy doesn't shit itself. Okay, guys, now this next point I really, really wanted to pay a bit more attention to, and I think it's very important. And the reason being is because if you read this paragraph, you'll actually know why I'm quite concerned about the Chinese economy, okay? Now, the reason why Qudian's delinquency rates have gone up with other dodgier players exiting is because, as I suspected and I worried about, these people aren't just taking a loan with Qudian, okay? They'll be taking a loan with Lexin Finance, YRD, PPD, your mum's shop, your dad's shop, everybody, they'll be taking loans from everybody under the sun, okay? And so the problem with that is it actually tells me that the borrowers in China, the younger generation, no longer have a higher savings rate. And they're turning into American consumers, right? They consume like their American counterparts. Now, the problem with that is that people are borrowing far more beyond their means. And so the minute that they can not refinance a loan and they can't keep cycling or stacking these loans, then they're obviously going to default. Because what they're doing is they're borrowing from here, then paying a bit, and they go, oh shit, we can't repay it all, let's refinance. So then they borrow some more from this guy to repay that guy. It's a never-ending cycle, right? So then when players exit the market and liquidity starts to slow down, then you have these people perpetually living in credit with their credit lines taken away. This is quite worrying, which was what I talked about in my last video, and that's why I'm like, look guys, Qudian was a hold for me, right? Now, I'll talk about a little bit later in the video why I actually won't have any qualms increasing my position by double, but that's still a very small part of my portfolio, okay, guys? But I think it's very important to pay attention to this because right now there is a liquidity problem in China. Borrowers cannot chain borrow, which is affecting their ability to borrow to repay their borrowings to borrow more, right? Okay, guys, now the next paragraph that I wanted to highlight is the CFO's comments about how them going, look, we're actually going to spend as little as possible to acquire new users because we don't want to be forced to have to lend, okay? Now, there are two reasons why I wanted to highlight this paragraph, okay? Now, the first reason is it does show conservatism within the management and their risk-averse nature. This is great, right? But then the problem with this is that, as you can see here, they're like saying, look, we don't want to over-lever, okay? Because we don't want to over-advertise. We just want the highest quality people coming to us, and we don't want to sort of flood the system with people, which again is sort of telling me that they sense that something's up with the whole Chinese sort of liquidity economy. So again, this is just really important to keep in mind. But I'm quite comfortable the CFO has said this because it shows discipline and it shows, sort of not trying to grow at any cost, but grow in the right way. So this makes me, again, happy to hold on to it for the longer term, okay? And again, guys, this paragraph that I highlighted, it really reinforces the fact that, when the economy is good, everybody's going crazy and lending money, but when the economy is not so good, then people need to hunker down, and that's when the industry starts to get in trouble, and the people left standing at the end of it will be the people who are responsible, right? And so, look, it's a double-edged sword. It shows great discipline and conservatism within management, but the problem is it also reinforces the current state of the Chinese economy and debt problem, which I talked about in the last video, okay, guys? So that's something to keep in mind. All right, guys, so the next point that I wanted to focus on is in terms of guidance, okay? Now, as you can see here, the CFO has been a little bit hesitant to give guidance. Now, I don't actually think it's the fact that he thinks he's going to lowball. I think that he knows what what next year should give in terms of numbers, but he was hesitant to give it this time around because, sort of I got a feeling that maybe it's a lot lower than what the market is expecting, okay? So we have to sort of price this in if we want to top up to first of all understand what kind of growth is the market expecting, but second of all, what kind of growth is the market pricing in, and then finally, what guidance are they going to give in the new year, and does that match or exceed or underperform the market's expectations, because that'll largely dictate which way the share price is going to go on the next call. Okay, guys? So this is something to keep in mind and for you to consider. Okay, guys, and then this paragraph again, not going to spend too long on it. It's basically just saying what I said a little bit earlier in the call, where it looks like the different banks and institutions and financing companies are data sharing with each other to be able to find the highest quality borrowers so that they can lend to specifically them, which I think is good, and it bodes well for the open platform for Qudian, because that's effectively what they do, right? So they do the first screen for people who have no credit history, no borrowing, anything else, and then the banks do the subsequent screen thereafter to then weed out from the pool of 21 the actual, best quality ones they want to lend to first. Because really what it sounds like is at the moment there is a bit of a liquidity crisis in China, and that people are finding it harder to repay now than when the economy was good. Okay, guys, so this is something again to keep in mind. Okay, guys, I thought this paragraph was important to pay attention to, and the reason being is, as you can see here, the CFO have said, look, currently on the open platform, it actually takes us 10 minutes to approve an application versus their direct lending model, which is 10 seconds. And his rationale for that is because they're actually not underwriting the risk. Their institutional funding partners are being a bit more, conservative and scrutinizing with the referrals, right? So what this tells me again is that, yes, you can say, look, their peers are approving loans within 30 seconds, and you guys might be losing out on traffic. But again, this is another point that reinforces the current state of the Chinese economy, and that, people are really, really, cracking down in terms of how hard they scrutinize all of the finance applications. Okay, guys? So it's a good because it shows diligence and discipline, but it's also a negative because it actually shows you the current state of the Chinese economy. Okay, guys? So that's something to keep in mind. Okay, guys, I thought it'd be important to bring this part of the earnings call to your attention, and let me just read you a couple of pieces, okay? So the CFO said, look, the control of the pace is absolutely under our funding partners, and the reason being is because we don't underwrite risk. So it's their risk appetite and their funding size, okay? And then moving down a little bit more in the paragraph, they said, look, I think Q4 will probably look good at a loan balance growth, but on a loan origination growth, it could be flat from Q3 because Q3 was a big step up. But when the ecosystem becomes 20 plus partners, then you'll see more of a linear quarter-to-quarter situation, okay? And so the reason why I wanted to bring this to your attention is a few-fold, okay? So first of all, buying Qudian now when they're focusing on the, the sort of open platform, you can almost say investing in them is almost like investing in a Chinese financials ETF or a banking ETF, right? And the reason being is because, the risk sits with the bank. The sort of risk underwriting Qudian doesn't do. So it really depends. And as you can see, the CFO said the pace is, with the lenders, right, and their funding partners. So what this really means is that, effectively you're just investing into like a screener, right? Like it's almost like a stock screener, but rather than screening for stocks, you're screening for borrowers and borrower quality. So, whether growth goes up or goes down, that'll actually largely be driven by the Chinese private lending financial market as a whole, right? So the good thing is Qudian doesn't really take any of the risk, and the risk sits with the funding partners. But the bad thing is then you're almost no longer investing in a fintech, but you're more so investing indirectly through the entire Chinese financial system through a fintech. So that removes the risk, but then the growth will then be determined more on a macro scale, I guess, rather than an individual stock. So I actually find this quite interesting. Okay, guys, now the reason why I wanted to highlight this paragraph is because I actually thought it does give a little bit of weight to the terracotta argument, right? Because of Qudian's current 17 funding partners, only 3 are licensed banks, right? Now, the rest are consumer finance companies, and then you've got a few sort of small internet micro lending companies, okay? And so the reason why I say this gives a little bit of weight to Terracotta's argument is they've said, look, these are really shitty quality regional banks and big proper banks that don't want to work with, micro lenders, right? And then you've got, like he said, 10 to 12 consumer finance companies. So that's pretty much 70% of their funding partners are consumer finance companies. And then you've got a few smaller shops. And I say, look, that is a good point. But then what's to say that, these might not be big consumer finance companies, right? And so I think it does give a little bit of weight to the terracotta argument, and that is something we should keep in mind. But look, you got to understand, China is a massive market, right? It's not like we're in Australia where you've got 4 big banks, right? They've got 1.5 billion people, and even in a small city of, say, 6 million people, and you have a regional bank there, I mean, that's bigger than the biggest bank in, Switzerland of 4.5 million people, or New Zealand of 4.5 million people, right? So I think it's about economies of scale. So, look, yeah, it could be a small Chinese bank, but when you're in a region or a city of 10 million people that's still considered a tier 3 city, then it's actually not that small in the greater scheme of things. Okay, so that's again, something we should keep in mind. All right, guys. So I thought it'd be important to take you through this paragraph, especially the bottom bit, and the reason being is because I think if I've interpreted the CFO's comments correctly, what he's saying is that there is a potential to lower the IRR, but sort of greatly increase the loan size to almost double and triple what it is. And so my understanding, if this is correct, is that there could actually be a potential for Qudian's business model to evolve, whereby they actually start using it for the bigger deals, right? So the higher value deals. And so the reason why I think this is positive is because it's almost taking somebody who's specifically helping the underserved and underloved into the mainstream, which I think could be actually a good evolution of their data analytics capabilities. So again, this is something that's quite positive and I liked about the call, and thought it'd be important to keep this in mind. Now, I wanted to highlight the next paragraph because I actually think that the company made a mistake by disclosing the D1 delinquency rates, and that actually caused the stock to get sold off and the market to shit itself. Okay, so I think in the process of being transparent, they've actually shot themselves in the foot, and I think it was actually a mistake disclosing the D1 delinquency rates, because just because you are a little bit late paying this one particular purchase doesn't mean it's going to default, because again, if you think back, their M1 delinquency rate is only 5%, and their M6 charge-off rate is only 2.7%, yet the D1 was about 10 to 12, okay? And again, I think they made a mistake by being transparent, but I think it's also important to remember, okay, guys, what I was saying before. People have to borrow to not only pay back their principal, but their interest. So what they're doing is they're borrowing, then they're refinancing to pay off the principal and interest, but then they don't have enough to pay that off, so that it's a continuous circle of refinancing, again, which is why I'm sort of worried about the Chinese economy, okay, guys? So look, do I think Qudian's at risk of going under? Of course not. On an M6 charge-off rate of 2.6%, that's 2.7%, that's nothing, okay, guys? But it does sort of, again, I guess, demonstrate the current state of the Chinese economy, which I think we should be cognizant of. That's the end of my take on the transcript for the latest call. And so just to conclude, as you can see, I've said here, look, I think Qudian is more of a bet on the Chinese financial system as a whole, without the balance sheet exposure. All right, so it's almost turned into that, because they've sort of gone from direct lending to saying, look, we'll just facilitate everything. We'll provide a platform where all you financial people can talk to each other and find the highest quality borrowers. So I think it's almost turned into, investing in a Chinese diversified financial ETF without the balance sheet risk. Okay, guys, so that's quite positive. So that's why I've said, look, I think it's okay to double the position, but look, two things I want to say. Okay, first of all, when I say double, I don't mean, if you're already massively invested, okay, guys, look. But for me, because I'm only invested a little bit, I'm okay to double, but I'm going to double in a measured and disciplined way, okay? So it's not just saying, look, I'm just going to immediately double. I'm going to double it slowly in a few chunks, okay, guys? And second point, guys, this is not financial advice, okay? And you should always speak to a professional before buying anything, okay, guys? So none of this is financial advice. This is just my thoughts on what I'm going to do with my money. Whatever you guys do, ask a qualified professional, all right? So now that we've finished the fundamental analysis, I just want to quickly take you through the technical analysis. And so I haven't bought more Qudian yet. And the reason being is because, as you guys may recall, it dropped to a low of about $4.10 before running up, 25% to where it is today. And so if we have a look at this chart, you'll actually see that, look, it's on a very, very good short-term uptrend, but there are quite a few resistances, okay? So first, there's currently sitting at the short-term resistance, and then they've got the sort of longer-term resistance of about, $5, $5.10, okay, guys? And so what this tells me, and I'm not an expert in technical analysis, but what this tells me is that, as you can see, they're at an uptrend, but the volatility, the swing highs and swing lows, they're starting to get a lot more even and a lot less emphasized, okay? And so what that means is, as you can see, when they're approaching the area of high confluence over there, what that means is that people are actually waiting for something to happen, right? So right now, people sort of don't know whether it's going to go a little bit higher or lower. And so, what I'm going to do is I'm actually going to watch how the share price plays out over the next sort of week or two before doing a bit of top up and increasing my position. And the reason being is because I think at the moment it's technically overbought, just because of how hard it's rallied since the lows. And again, looking at the daily chart, as you can see over here, it's now, so if we go back to the weekly chart, you'll see that this is effectively a triple top, right? And so typically when this happens, it's going to take a little bit to break through the sort of triple top. And so what I'm going to do is I'm going to be watching throughout the course of the next week or two and just see if there's a better opportunity to enter. If not, and I missed the boat, that's okay. But if so, I'm sort of more than happy to buy if it goes back down to about the, sort of maybe 450, 440 kind of mark. And the reason why I say that is because if you look at how the stock is, traded, right? After every big sort of rally, there's always been a bit of a pullback or a massive pullback, right? So there is quite a bit of volatility. And so just looking at the sort of trading history, I'm thinking that, look, this rally is, I'd be very surprised if it doesn't pull back, okay, guys? So that's sort of my thoughts and what I plan to do. But again, look, none of this is financial advice. So do your own research, speak to a qualified professional. And look, guys, that's the end of the video. Hope you enjoyed the update. Make sure to leave a like and drop a comment. Happy investing, and I'll catch you in the next video.